Trident Capital is a specialist alternative asset management operation. Specialist in that it focuses on its core expertise, and alternative because of its unique company structure. The group has 4 types of funds: real returns, hedge, fixed income and offshore. For more on the company's investment philosophy, Kimon Boyiatjis, Managing Director of Trident Capital. Why is your company structure so unique, Kimon?
Because we don't want to do run-of-the-mill funds, and I think we're also quite unique in that we select our clients. It's almost a reverse situation. So we're fortunate enough to be in that position. But most of the reason is we don't like to play in I personally have never been a great fan of relative performance, and our focus is unique because we're just looking at absolute performance in any of the funds that we manage.
Kimon, if you look back over, let's say the last 12 months, the last 18 months, we've had, again, ongoing volatility, uncertainty. If you look today, we've got equally as much uncertainty around Europe. How are you generally playing this type of environment where the news flow can be so erratic and where you can kind of be up one day and down the next day in terms of your thoughts around the prospects? What is your strategy with the current environment?
I think it's a good question, that, because I think it's pertinent to the way most people should be investing. We're not reactive. We've always look at, firstly, asset allocation. That's I think our major strength. When we look at a portfolio, we don't just look at equities or bonds. We look at it as a fully inclusive portfolio. So we are good at asset allocation, and I suspect that if one does one's asset allocation correctly, you don't get caught up in the noise of what you see on a daily basis in the markets. I think strategically what we have done is we believe that don't put all your eggs in one basket, and we really look at the value of each asset class first and foremost. And I think that's where another reason why we are unique. We're looking at that asset class allocation, and the way it is currently structured is very, very conservative. And we've had a particularly good run over the past couple of years, mostly because of the asset allocation. I think you can also make bad investment decisions. One of my worst investment decisions recently was to buy Amplats. You know, we got out of that. We were totally wrong. We thought there was a good case for that share. But one of our strengths, again, is to be able to cut our bad decisions. So we cut our bad decisions and let our good decisions run.
Let's talk about this asset allocation of yours and what assets you're favoring in the current uncertain environment. Considering, off air a minute ago, you were saying that you are concerned about Spain and the situation unfolding there.
I think we have a lot of noise coming out of Europe and some real worry. I think the focus has really been too much on Greece over the past while. And while that is very important and possibly a catalyst for possibly worse things to come, I'm very uncomfortable with the situation in Spain. I can't see how they're going to be able to recapitalize the banks. Bankia is an example. 2 weeks ago, just 2 weeks ago, they were looking at 15 billion euros to recapitalize Bankia. Now the estimate's closer to 20. In fact, quite specific, they were at 19 billion at the last report. I can't see where that money is going to come from. I don't think the structures are in place to bail out those banks, and I think the problem's too big. So that will certainly have massive ramifications around the globe. I think everyone's a little bit too focused on the Greek problem. Now, if there's a problem with Spain, we're then going to have a problem with Portugal, possibly Ireland, although to a lesser degree. And, you know, I think even Italy is not going to be able to be out the fray. And I can't see Germany bailing them out. So I think with all that uncertainty, what does it do? It tells you that our growth numbers are going to be down. I think economic activity is going to be largely subdued in the euro area. We're seeing China slowing down, the US doing a little better. But my worry globally is that the growth levels that we've been forecasting and expecting are going to be worse than usual. So what does that mean? Diversify your portfolio correctly. And
this is what I want to know what you're doing. I want to understand how you're diversifying among assets.
Okay. We are at the low end on equities, between 40 and 45%. We at the top end with regards to inflation-linked bonds, which we view as a completely different asset class to vanilla bonds. So we're up at 20% there. We're at 15% on vanilla bonds, so that would take you 35% plus the call it 45% on equities. That takes you to 80. 5% gold holding, which we've spoken about before, physical gold though, not gold shares. And we look at gold in a number of ways. Firstly, as a store of wealth, and secondly, as a diversification tool with regards to other currencies, and quite a high level of cash. So the cash is around about 15%.
Kimon, in terms of this allocation, have you got any exposure whatsoever to Europe? Or is it just simply you look at it and you say, I'm going to avoid the region entirely? In other words, what I'm trying to get at is through all of this uncertainty, are there any sort of glimmers of value where you could look at this and say, this asset is completely oversold given the situation and I'm going to look at putting that in a portfolio? Or do you just completely avoid it?
No, we do look at specific assets that we would like to have in a portfolio despite the regional difficulties that we have. I mean, we saw it in 1929, although the 95% of shares dropped, there were a couple of good ones that actually rallied. So when we're looking at Europe, for example, if you want exposure to that region and a share that's particularly good, in fact, there are a couple of shares that I personally like. If I was looking at the share market, Nestle is one of them. It's a solid performer, good cash flow, and maintains dividends. Richemont has got large exposure to Europe, although one thing I do like about Richemont, it's diversified across the globe. So those are the kind of shares that we would have. We wouldn't totally avoid the region. We might avoid certain countries. You don't want to be in the banking shares in Greece right now.
Nestle, just touching on that stock, has about 40% exposure to emerging markets. So that's also working in its favor from your perspective.
Well, I think we fall into that category. So we already have exposure in South Africa. So we wouldn't really look to go and get exposure to Brazil or India. Possibly China might be an area that we would look at. We wouldn't totally ignore emerging markets because they're doing particularly well. But what we would have a look at are regions where, or specific regions that might complement our current strategy.
Kimon, can we just come back to your comment on Richemont and in specific a view that some people express to own multinationals or to own companies that are able to derive a benefit from wherever there is growth around the world. How do you view that strategy? Is it something that you would follow in terms of trying to stock up on multinationals?
Absolutely. I think you can take another example would be breweries. Second biggest brewer in the world. The great thing about those multinationals, in fact, the whole point of diversification, you actually, reinforcing that idea by buying multinationals, and you're not totally exposed to one single currency or one single region. And that gives me a much greater level of comfort when I'm looking to buy any stocks.
Just in terms of your sentiment on Richemont, 49, 48 Rand, you still think it's got legs from these levels?
I don't think I'd be buying them at these levels, but I think I'm happy to sit with them. And we've got a target around about 55 where we would actually exit. So it's about 10% higher roughly than where it is currently.
Before you ask another question, what's your view on Richemont?
Very good.
Are you buying at these levels?
Yeah, I think it's, I guess when you see the results, you constantly, or to some extent, you're surprised by the buoyancy given the uncertainty. But, I think the Chinese exposure is superb. When I looked at watch industry sales, they had an absolute record year last year. If I look at advertising around watch brands in the US, for example, it was a record year. So at that luxury element is doing actually very, very well, despite all of these woes. So, and I think Richemont does that part of the segment quite well.
With these additional woes entering the system, Kimon, as you were indicating, specifically in Europe, I'm surprised that your gold holding is only sitting at 5%, given that you are an inherent gold bull. And here again, I'm talking about the physical metal. I know your exposure is always direct. It's not through the gold stocks.
We were as high as 10% last year, and we reduced that in the last quarter of last year. We just felt that the market needed a bit of a pullback, needed to consolidate. We'd seen 12 or 11 years of upward momentum on the gold price, and I think it was time to actually take some money off the table. We don't like to call tops and bottoms, but we felt that it was in a risky area, and when it was up near $1,800 an ounce, we just felt, that was really it for the time being. I'm not saying it can't go higher, but I'm much more comfortable if I'm looking to pick it up around about $1,400 or $1,200. Having said that, we're a little negative on the rand going forward. I think the risks of us being downgraded locally are a little bit higher, and therefore I would again look for those multinationals, which again would have some currency hedge for us through the weakening rand.
Kimon, earlier on in the discussion, you said that your portfolio was conservatively positioned. What would need to change for you to become a little bit more aggressive in how you're positioning? Is it literally all about Europe? In which case, is it likely to change significantly in the shorter term? In other words, give us some idea of what would make you a bit more adventurous in terms of the structure of your portfolio.
When you mean adventurous, what kind of level would you think would be adventurous? Because I can't see us ever going much higher than 50% with respect to equity. So the range really would be around about 40, possibly even as low as 35 at the extreme, and maybe 55% exposure to equities. What I'd like to see is results being consistent. I'd like to see a trend of growth. I'm not looking for one or two good numbers coming out of the States. So that's why I say we're not really that reactive. What we try and do is do reasonable short-term forecasting. We don't do any long-term forecasting. I think if you do good short-term, 3 months to 6 months, and your forecasts are reasonably accurate, you've got a much better chance of getting the long-term right. I'd like to see a bit more stability. I'd like to see a plan come out of Europe. For one, I think that would give me a greater level of comfort. I still think that we may have problems down the way with respect to the US. I don't like the fact that the interest rates are so low. Again, that gives me a great level of comfort when holding physical gold. So I'd like to see the environment improve, and I'd like to see it coming through in a consistent set of numbers and where we can see trending economic activity.